Good afternoon, everyone. Welcome to Wealth Capital Management's Q3 25 Financial Markets Insight webinar. For those of you who don't know me, my name is Remington Borg, and I am the Portfolio Administrator at Wealth Capital Management. I will be today's host, so if any of you have any questions during or after the presentation, please enter them into the chat, and I will help facilitate answers. We are delighted to have you join us for what promises to be an engaging and informative session on the state of today's markets and what it means for long-term investors. As many of you know, our presenter is Cean Rogers. Cean holds his CFA designation and has over 20 years of experience in the financial services industry. Throughout his career, Cean has guided clients through diverse market environments, helping them navigate both challenges and opportunities with a disciplined, research-driven approach. He structures portfolios across a broad range of asset classes and will provide a comprehensive view of today's investment landscape. Whether you are a client, a market enthusiast, or someone seeking a clearer perspective on where we are and where we might be headed, you'll leave with actionable insights and a sense of the value wealth brings to clients. So without further ado, please join me in welcoming Cean.
Thanks, Remy. And thank you to everybody for joining on our call this evening. We're going to jump right in today. First off, just wanted to let everybody know that due to the continued government shutdown, today's presentation is going to be a little bit different than normal because a lot of the data that we look at during these presentations is currently not being published. And so we've got to look at different alternative sets of data, but it's out there, and trust me, we look at it. So you'll see a little bit different, some different numbers, but we still in general are looking at the same type of data. We'll start with the global economy here. At the beginning of the year, the IMF projected about 3% for global GDP for 2025 and 2026. The US forecasts were slightly lower than, by the IMF, that is, we're slightly lower at 2.0 and 2.1 compared to the CBO's estimate for 2026 of 2.2%. In the long run, the CBO is projecting the US GDP growth between 1.6 and 1.8%. The gist of this is in 2025, the economy is currently growing at a very decent clip. That's the main point here, and it's not all coming from the US, which has been a little bit different than the more recent past, especially from other developed countries. But we are US centric, and we focus a lot on the US, so we'll go ahead and dive in to the US GDP here. Q3 data, as I was saying before, the government, because of the government shutdown, we don't have Q3 data. However, one of the pieces of data that we look at is this GDP Now cast from the Atlanta Fed. And it is currently, as of this morning, showing that Q4 is running at about 4% GDP growth in the current quarter. Now, because of some of the items that have happened in 2025, i.e. tariffs, we do have a lot of noise in these numbers. So I want to point out Q1 and Q2. I want to point out the purple and the blue. The purple is net exports. And you can see that in Q1, we had a giant amount of net exports that were imported into the United States. So we had tariffs that were announced that were going to go into place on April 1st. And just like you would think, many companies front ran those tariffs and sent in goods into the US at a very large clip to avoid those tariffs and build up inventory. And then you can see that in Q2, we had a complete reversal of that. So we had a massive amount of where imports were greater than exports. And then you didn't have as many imports when the tariffs kicked in. So you had less imports. So you actually had exports that were outpacing imports in the second quarter. They kind of offset each other, as you can see here. The other item is inventories. And so in Q1, we had a build of inventories. And in Q2, we had a drawdown in those inventories. And you can kind of see, it's very visual here. You can kind of see uh, they're about the same. So they kind of offset each other. So if you look at the less volatile mix of these components, you can see that in Q1 and Q2 of 2025, we've grown right around that 2% GDP growth number that both the CBO and the IMF were kind of pegging the U.S. at growing. And then in Q4, it looks like we're running a little bit above that. But again, the government shut down, so we'll get official numbers once the government is no longer shut down. The biggest driver of US growth, and if you've been a frequent listener to this call, you would know this, is the consumer. You can see that 2/3 of GDP growth is this big blue bar chart right here, which is the consumer spending, consumption. If we look at the consumer and we dive in, you can see that it's really the tale of two stories here. We've got the high-end consumer that has significantly increased their spending since 2019, much higher than inflation. This is the very high income and the high income folks. And then we have the middle income and lower income folks who have struggled to keep up with inflation. Now, as long as the high-end consumer keeps spending, because of the outsized amount of spending that the high-end consumer does, U.S. growth should continue to increase as long as that high-end consumer is able to and keeps spending. If we have any pullback in that high-end or very high-end consumer, it may have a chilling effect on the US economy. Currently, consumer spending remains solid despite a little bit of cracking in increasing credit card balances, increasing defaults. And if you look at some of the consumer survey data, you can see that consumers are a lot less optimistic. And a big part of that is probably these middle income and lower income consumers that are struggling to keep up with inflation. So while we're talking about inflation, let's go back to trade and tariffs and the implications. Tariff revenue has increased steadily since April, despite imports falling, but this is simply a function of increasing tax rates. Rates went from 2.5% at the beginning of 2025 to about 11.3% as of August, leading to $30 billion of revenue collected in the month of August from tariffs. There are signs that these tariffs are making their way through to consumers in the form of higher prices. There's no question that tariffs create inflationary pressure. It's just a question to what extent the consumer is going to pay for it. If we take a step back, the U.S. Customs and Border Protection collects tariffs from the importer of record. This is basically the same as if one of us went abroad, came back, and on the plane, they tell us to fill out that little form. And if you've got anything that's of value over $800, you have to declare it and you have to pay tax on it. This is the same type of situation with importers. They have to pay the tariff. There's only three options to pay for the tariff. One, you either get a concession from the exporter. Two, you pay them through margin contraction. Or three, you pass them on to the consumer in the form of higher prices. In reality, most likely, it's going to be a mix of all three of these. If the demand for the good that we're talking about, the good or service, mostly goods, is inelastic, meaning as price increases, demand doesn't decrease by as much. So you have an inelastic demand for the good. In those types of situations, more of the tariffs will be passed on to the consumer because a higher cost doesn't necessarily decrease the demand for the good. You can see these in goods that are necessary, like drugs, and in some cases, luxury goods. Any price changes might be passed on over time rather than in one fell swoop immediately. Some of these exporters and importers that are selling these goods, they may assess how demand is holding up. They may eat the initial cost and then assess how much they will be able to pass on to consumers. But ultimately, we believe that this is going to lead to higher inflation. Now, if you haven't heard, the Supreme Court is going to be ruling on whether or not these tariffs are allowed or not. It appears that the betting market is telling us that the Supreme Court is not going to rule in favor of Trump's tariffs. If that's the case, the US may have to pay back a lot of these taxes that they've collected, and this process could be very messy and very confusing. If that were to happen, we would still expect tariffs. We just would expect a lot lower tariffs than what we had originally expected, but still higher than the beginning of this year. Speaking of inflation, I'll go back to inflation. The CPI was one of the data points that actually was released even during the government shutdown. And that's because it was needed in order to calculate the COLA on Social Security. So they did figure out a way to release the CPI data. Both core and headline came in year over year at 3% for September. Inflation, that's basically in line with where expectations were. But we have to remember the Fed's target is 2%. And you can see here, even though we're at 3%, which is much better than in 2022 when we were at 9%, we've started to tick up. This trend is increasing, and we believe that in part is from those tariffs. Where do we think inflation is headed? In order for us to get a good idea of where inflation is headed, we can look at break-even inflation. The market basically tells us what the market believes inflation is going to be over the next 5 and 10 years. And depending on what we're looking at, the market is telling us to expect somewhere between 2.2 and 2.5% inflation. which is not quite the 2% the Fed would like to see. But again, the Fed is really looking at PCE versus CPI. So a 2.2% break even or 2.25% break even would probably get us to pretty close to where the Fed is going to want us to be. Okay, so we've talked about inflation, we've talked about growth, we've talked about tariffs. We're going to move on to the labor markets. Hiring has significantly slowed since the beginning of the year. This is non-farm payrolls, and this is through August, because again, government data is only showing us through August. You can see a significant, this is the 3-month average. It's dropped to 29,000 jobs per month. And in August, it was 22,000. The labor force was increasing at a really good clip since COVID, but you can see more recently we've had a drop in labor force. We've had a drop in supply of jobs. We've had a drop in demand of jobs. We've had policy changes. We've had enforcements leading to a contraction in growth of foreign-born labor. In terms of how many foreign-born workers are undocumented, the estimates are about 8 million, but the measurement is difficult and indirect. First and foremost, undocumented workers are less likely to respond to CPS. The current population survey is showing 60,000. So we've got a lot of noise in the data right now because of the immigration policies. And it's had an impact on our labor force. If we look at some of the data that has come out, we can see that on Wednesday, ADP private payrolls came out, and it showed a 42,000 increase in payrolls in October. If we dive into the numbers, we can see that ADP has really showed over the last 3 months, it showed very anemic job growth, very anemic payroll growth. And if we really dissect the data, you can see that all of the growth has come from the blue section, which is large companies. And we've actually had medium and small companies decrease their payrolls. Very important to see that, because we generally will see small and mid-sized companies start to pull back first, and they are much larger job creators than large companies. 3 out of 4 jobs are filled by small and medium-sized companies. So we definitely take note when we see this type of a phenomenon that we've seen over the last couple of months. Now, how well is ADP at predicting the non-farm payroll? So the gray is non-farm payrolls here, and the black line is ADP. So you can see it's not exact, but you can see that it's pretty close. Yes, there are some gaps here where non-farm payroll was much higher than ADP. You can see some gaps the other way, but for the most part, if you smooth it by looking at the 3-month average, you get a pretty good idea of where we're at. And it's not great. It's showing, pretty close to flat job growth in the US. If we look at another non-government number, we can look at the Challenger announced job cuts. You can see 153,000 job cuts in October, the highest October total since 2003. And we had a big spike in March of this year as well. So if you put that all together and you look at the cumulative job cuts that have been announced in 2025, you can see that this dark blue line here is 2025. This small blue, it's also blue, is 2009. So we are rivaling 2009 as far as job cuts. Again, here's some government data. It's pretty dated. We've got August numbers here. We were showing unemployment of 4.3% in August. It'll be very interesting when the government reopens and we get some of this data to see if the unemployment rate has ticked up a bit as job creation has come down and layoffs have gone up. We're going to move to global equities now. This is the first year in a long time where the S&P 500 has not been the best performing equity market. You can see that in US dollar terms, the S&P 500, this is as of October 27th, so last Monday, the S&P 500 was up 18.1% in US dollar terms. The all country world index returned 30.3%. Of that 30.3%, you can see that a good chunk of that, almost 8% of that, was due to the weakening of the US dollar. The long run, the last 15 years, you can see that the S&P 500 still has starkly outperformed foreign markets ever since the great financial crisis. We're at 14.6 annualized return for the S&P 500 basically since about the great financial crisis. That is a very high number, and we'll talk about it a little bit later in the slideshow. Compared to all country world index ex-US has been running at about 6.5%, and some of these emerging markets are 4.5% over that 15-year period. Because of this strength in the US, when you're looking at the weight of the US in the MSCI All Country World Index, you can see that if we go back to 1987 and look, we now, if we own the All Country World Index, we're not as diversified as we used to be. We have 65% of that All Country World Index is now the US. And that's because the US has done so well, and the market capitalization of the US has increased over that period of time relative to all of these other areas. So another item we just need to make sure that we understand. The US dollar has been a significant driver of some of that outperformance. Although this year to date, the greenback is down 9%. But you can see from the great financial crisis to September 2022, the dollar increased 56%. And so far in 2025, we have a 9% decrease. Now, why is this important? Because it tends to, when the dollar does well, US equities tend to outperform. When the dollar comes back a bit, international stocks usually do better, and it's because we have that foreign currency tailwind. If we look at the US stock market and we really dive in, again, there's a bit of a two stories here where we have the largest of the large companies, and then we have other US stocks. If we just look at the top 10 companies in the US, we're very familiar with them. Everyone probably uses some of the products that they make in your daily lives, or you search on Google, on the internet, or you use an Apple phone, or you use Microsoft on your computer. We all are very intertwined with these companies. They're great American companies. They've done absolutely fantastic. If we look at the top 10, we can see that the price to earnings multiple currently is running at 30 times, the price is 30 times earnings. On average, this PE multiple for the top 10 companies has been about 20 times. So we're significantly over from a price to earnings standpoint. Now, if we look at the market cap of these companies, the top 10 companies now, if you buy the S&P in your 401k or you buy the S&P 500 index fund, and it's a market cap weighted index fund, which most S&P funds are, for every $100 that you buy, $40 goes into these top 10 companies that I would argue are pretty expensive. Now, they are, the market cap has increased and their earnings has also increased. 32.5% of the S&P 500's earnings, 32, almost a third of the S&P 500's earnings are coming from these 10 companies. That is just a very, very large number. If we look at other valuation metrics, and you know, we don't just look at price to earnings. Price to earnings for the entire S&P is almost 23 times. If we look at those, the largest of the large, those top 10 companies, it's 30. You can see the 30-year average is about 17. If we look at the Case-Shiller, the cap ratio, you can see it's 40.7, which is extremely high. The 30-year average, again, 28.4. The dividend yield is at 1.5%. The 30-year average is 2%. The earnings spread is negative 0.5% versus the 30-year average being 0.7%. So no matter how you look at it, the S&P 500 is expensive. It's not cheap. That doesn't mean it can't get more expensive. It doesn't mean that stocks can't continue to go higher. It just is a starting point for us to look at where we lie compared to history. The reason we look at valuations is because over the long run, valuations matter. Over the short run, valuations don't really tell us that much. This is a scatter plot of forward PEs versus subsequent 1-year returns. You can see there's really, the R squared is 5%. The dots are all over the place. There's not really a regression here. If we pull that 1-year return and we look at 5 years, or even if we pull that to 10 years, valuations start to matter a lot more. And what a 23 multiple on the S&P 500 is telling us is that our forward returns are likely going to be much lower than they have been over the last 10 to 15 years. So if we go back to that slide where it showed the last 15 years, the S&P has done a little over 14%, very unlikely to continue over the next 10 years. Markets are extrapolating the past into the future. And we believe markets are not really pricing in all these risks. The growth expectations discounted today are about as optimistic as they've been in 100 years, with the exception of right here, the dot-com bubble. So you can see this is implied earnings growth. We're at the highest level that we've been pretty much, other than the dot-com bubble and other than the late 80s, early 90s, where we had a spike in implied earnings growth. So again, just another way to look at, hey, you know, what's going on here? Maybe things are getting a little bit excited. Maybe there's a preference to those largest of the large companies because we all have familiarity with them. We all use their products every single day, and they've made our lives a lot easier and better. Uh, and we've preferred to own those types of companies. If we look at profit margins, which profit margins are you know, that's how we get to our earnings, is we look at our revenue and we look at how much of the revenue we keep, and that's our profit margin. You can see that after the 2022 you know, mild slowdown, we had profit margins come back. For US X tech, we have profit margins going right back to their long-term trend. With tech, we see something completely different. They came back and then they spiked up to even new highs. I don't know if they're going to stay there. What I will say is I want to know that they're elevated, because if things don't stay where they are now, if something happens where they go back to trend, that's going to have a significant amount of pressure on earnings. And if we go back to our previous slides, earnings matter. Stock prices over the long run follow earnings. And so we want to know where we sit when we're assessing risk in our portfolio. The hyperscalers have spent a very an insane amount of money on data centers and AI spending. You can see here we're gonna get to where these hyperscalers. So this graph here shows Alphabet, Amazon, Meta, Microsoft, and Oracle. You could add more to this list, but these 5 companies are going to be spending about 60% of their operating cash flow on CapEx very soon, if not already. Here's a different way to look at it. Very similar chart here, but the math is pretty simple. Unless there is a surge in revenue from these activities, big tech is going to pump nearly all of their free cash flow into CapEx in just a few years. So here's, I mean, their free cash flow is dropping by 43% through Q1 of 2026. We have to pay attention to this. There's a little bit of FOMO going on, and it could end up, if the revenues are produced, wonderful. If they aren't, then things are probably really, really expensive. And so we just need to understand what's going on. Just another way to look at it, the Magnificent Seven. I thought when I saw these charts, I thought they were good to add in to emphasize this point. If we look at AT&T in 2000, they were spending about 21% of their revenue on CapEx. You can see utilities currently in the current environment, utilities are spending about 28% of their revenue on CapEx. Meta, Microsoft, and Alphabet are all spending, and we could throw Amazon and Tesla in there, not as much, but these companies are spending so much money, they are starting to look less like an asset light companies like they were in the past to more of a capital intensive that's approaching that of a low returning utility sector. So just, there's a lot of similarities. History doesn't repeat itself, but it sometimes rhymes. We just want to be very aware of these spending amounts and the risk of AI paying off. It's going to be transformative. There's no question about that. It's just, how does it play out, and how does it turn into revenue, and how does it ultimately turn into earnings? It is a very crowded trade. You can see that venture capital investments in AI has significantly increased as a share of total. And we're talking in Q1 of 2025, AI related companies were 71% of venture capital investments. And you can see that there's a lot of deal value, or deal value and deal count in venture capital in AI deals. So it's not like this is a secret anymore. Everyone knows that this is a game changer, and it's going to be a transformative technology. And investors have voted by putting their parts of their portfolio and making investments in these companies. And you can clearly see investor preference in the valuations. I thought this was, JP Morgan added this slide to their deck, and when I saw it, it was just it just hit me, and I was like, I got to add that to our slide deck. You can see here, this is 1985, 95, 2005, 2015, 2025. We've got market total market capitalization, and we've got color coded the top 10 companies of that decade. And you can see in 85 we had green, and slowly the green went away, and by 30 years later, we only had 2 of the original companies on that list. Same with 1995, we have gray. By 2015, we have 1 gray on the chart. By 2025, we have no green and no gray. We have a complete new list of companies from 85 and 95. We only have 1 company from 2005. Only 1 company that was on the list of top 10 companies in 2000. 2005 doesn't seem like that long ago. Microsoft is the only company there. 2015, we had the top 10 companies here. There's only 3 of those companies left: Apple, Berkshire, and JP Morgan. So the whole point of this chart is the companies that are the top 10 companies in the US, they change over time. I'll bet if you went back to 2005 and you talked to people about some of these companies, they would have thought that these companies would have been large companies, if not the largest top 10 companies going forward. And you can see that they change over time. And Alphabet, Amazon, Microsoft, and these companies that we use in our everyday lives, there's going to be a new list of companies that come and disrupt this list. It's happened. It's very clear that it'll keep happening. All right, so that was equities. Let's move on to fixed income. Fixed income has done fairly well for fixed income this year. You can see the aggregate bond index, the US aggregate bond index, up about 7.5%. Interest rates have come down since the beginning of the year, which has helped our bond. As interest rates go down, our bonds are helped. We have an increase in values when interest rates go down. And you can see if you have short-term bonds and interest rates fall, you get a little bit of a bump. If you own, so that's a 2-year treasury. If interest rates fall by 1%, a 2-year treasury gives you a benefit of 5.3% in an increase in the bond. If you own a 30-year treasury and you have a 1% fall in interest rates, the total return in that environment would be 21% almost. So the longer duration you have, the more interest rate changes impact your total return. So when interest rates are high, it's a good opportunity for us to lock in maybe a little bit more duration in the portfolio. And in October of 2023, we did that for clients. We had a 10-year treasury that was at about 5%. We moved some of our bond portfolio into longer duration bonds. And we've benefited as the 10-year treasury has come down to 4% over the last, call it, 2 years. Credit spreads and defaults. Credit spreads are at very low levels. Defaults are also at very low levels. If we look at private credit and we look at just yields and valuations of bonds, you can see that higher quality bonds are paying us a higher yield compared to the 10-year median. And some of our higher yield stuff is not paying us, is not giving us as much of a yield advantage as it had, not much different from the last 10 years. So what this is telling me is maybe higher quality is more attractive today than it has been over the last 10 years. Again, here is where rates were at October 19th, 2023, when the 10-year treasury hit that 5%. It didn't stay there very long, but it did hit 5% in October of 2023. It is now currently at 4.1. We had a flat-ish yield curve in 2023, and that yield curve has steepened significantly and decreased. And then you can see from peak inversion where short rates were extremely attractive compared to longer term rates, things have adjusted where short term rates have come down and long term rates have went up significantly from July 3rd to October 19th in 2023, and then back down to where they currently are now. And we believe at these levels we're getting a decent yield for the risk that we're taking going out on the yield curve. Portfolio implications. So like I said before, we just have to be aware of where we are from a risk standpoint. The S&P 500, if we're looking at a market cap weighted index, you've got 40% in 10 names. And those 10 names are fairly expensive if you look at history. If you look at just the trend channel, you can see that we're above this trend channel currently. And that tends to not, we end up in this channel. So if we're at the top end, we usually have a pullback to kind of bring us back in line. So we're right here, we're above trend line. We need to know where we are relative to history. If we look at global stocks, we've got to go back to 1999 to see a larger proportion of global stock markets simultaneously making all-time highs. We are in a period of time where investors are okay with stocks. It's not like 2008, 2009, where investors were deathly afraid of 2000 stock or of equities after the great financial crisis. Investors are certainly just fine with the risk, and they have not really been penalized for taking risk, with the exception of a very few short period, a very condensed period of time during COVID, during 2022, during 2018. Other than a very short period of time, very short periods of time, buying the dip has proven to be a very good strategy over the last 15 years. That might not always be the case. This is, most people on the call are familiar with Vanguard. Vanguard and other investment institutions do long-term capital markets assumptions, usually yearly. I just pulled theirs up to give us an idea of what the last 10 years of historical performance has been compared to Vanguard's 10-year projected returns. Now, what we used on this chart here was Vanguard's 50th percentile, so their median projection. We'll look at U.S. equities here. U.S. equities over the last 10 years have about a 14% annualized return. Vanguard is expecting a return of less than 4% from U.S. equities. Emerging markets and developed markets over the last 10 years, again, we haven't had as good of returns from these areas. Vanguard's median case for each of these is about just over 4% from emerging markets and just over 6% from developed markets ex-US. REITs have not had a good 10-year run. Vanguard is predicting that they'll have a better run over the next 10 years, but still, under 4%. Bonds over the last 10 years, because interest rates have increased pretty significantly in this 10-year period, bond returns have been just shy of 2%, barely keeping up with inflation over the same period of time. Vanguard is predicting their expected return for bonds is a little bit higher than 4%. Global bonds a little bit better than that, and commodities a little bit better than that. The point of this slide is to show it's not, you don't always want to chase the things that have done the best. A very prominent investment firm, Vanguard, that a lot of people on this call know, they're saying do exactly opposite of that. For the most part, they're saying there's better opportunities in some of these asset classes that have not performed the best over the last 10 years. If we look at returns from the S&P 500 over decades, we can see that the S&P 500 has done well if you look out over 20, 30 years and you look at 20, 30 rolling year periods of time. However, if you look at 10-year periods of time, you can see that there have been some periods where there's been pretty anemic returns from the S&P 500 by decade. The 60s and 70s, we were at 4.4 and 1.5%. The 2000s, we had a negative decade. We had a lost decade. We had negative 2.6% annualized returns for the 2000s. Now, that's sandwiched in between 12.8% returns in the 80s, 15% returns in the 90s, 11% returns in the 2010s, and almost 14% returns in the 2020s so far. So we need to understand that there can be 10-year periods of time where we have a complete lost decade. If we go and we look at that lost decade and we say, gosh, you know, I really like the 12.8 and 15.1 and 11% and 13.9%, but I really did not like this negative 2.6%, especially if I retired right at the beginning of 2000. That would have been a very bad time to retire, especially if your portfolio was overexposed to large cap US. So we went ahead and we said, okay, well, what if we, instead of owning US equities, where we had a negative 0.9% rate of return here, what if annualized rate of return, what if we had some international equities in the portfolio? What if we had some emerging markets exposure? What if we had some bonds and some real estate? If we had a diversified portfolio, and I'll define this diversified portfolio. What if we had 25% in US equities that did poorly, and we had 20% in international equities, which also did poorly? But we had 10% in emerging markets, 35% in bonds, and 10% in real estate. And we didn't know which asset class was going to have the best return over this 10-year period of time, but we had a lot of the asset classes inside of our portfolio. During this 10-year period of time, our diversified hypothetical portfolio here would have earned 5% annualized. It's not about knowing which asset class is going to be the best and trying to outsmart the market. It's about having all of these in your portfolio and having the appropriate time frame to make sure that you can get these outsized returns and not have to sell at an inopportune time. Speaking of selling at an inopportune time, so that other slide was about diversification. This slide here is telling us we have to have the right time frame for the asset classes we're going to add into the portfolio. So if we're taking from the portfolio on a yearly basis, or we know that, hey, we only have 1 year to invest, this is telling us that if we look at the last 75 years, our best rate of return from the S&P 500 was 52% in 1 year. Our worst return in a year was we lost 37% of the portfolio. If I have a 1-year time horizon, I am not going to want to tell you, well, your best return is going to be 52%, and a year from now, your worst return is I give you 63% of your money back. If you need to use that money in a year, you're not going to want to take this risk. However, if you told me, Cean, I have 20 years to invest, Now I can look at the S&P 500 and I can tell you we have a really good chance of making money. In fact, there hasn't been a single 20-year period, a rolling period, where we have earned less than 6% from the S&P 500 over a 20-year period of time. Even if we would have started in this lost decade, we still would have done 6% if we would have held the S&P 500 for 20 years. So right now, I think by now you guys understand that we think that the S&P 500, especially the top 10 companies, maybe is a little overpriced. If you have 20 years, it's very likely that the 20 years will still produce an acceptable return even with these starting valuations. Okay. Again, we want to match the time period you have to the investment that we make. If you're consistently pulling from your portfolio, well, it better be earning income. There better be some income, dividends and interest that are generated from the portfolio. And you better have a decent amount of time. You know, if we're looking at a 60-40 portfolio, I can tell you that a 60-40 portfolio over this 75-year period of time, 60% in the S&P 500 and 40% in the aggregate bond index. If you gave that portfolio 5 years, the worst return you would have gotten in that 5 years is 1% annualized. So we want to make sure that we have the correct time frame, the correct income, the correct cash buffer for whatever goals we're trying to get accomplished. That's what portfolio management is all about. It's not about timing the market. It's about time in the market. And with that said, we can see here portfolio, the long-term view. Again, it's impossible to know which asset class is going to do the best. We've had some of the portfolio in emerging market equity. In fact, we've been a little overweight emerging market equities because they've done pretty poorly over the last, call it 5 years. No one knew that emerging market equity was going to be the top performer so far this year through November 6th. Or actually, this is through, I think, October 27th when we pulled this data. But it's up 34.2%. If we didn't have any exposure to emerging market equities, we wouldn't have made 34.2% in that area. Developed market up 28.6%. US large cap still up 18%. On top of a 25% in 2024 and a 26% in 2023. If we look at an asset allocation, a more diversified type portfolio, the whole point of this slide is you're never, with a diversified portfolio, you're never at the top, you're never at the bottom. You're kind of right down the middle. If you're a golfer, you're right down the fairway. That's what we wanted. That's where we want to be. Generally speaking, if we've got some goals from the portfolio, if we need to have some income from the portfolio, and we don't like to see these massive fluctuations in our portfolio. And you can see from 2010 to 2024, a diversified portfolio has earned about 7%. And it's had a standard deviation of about 10.4%, a volatility of about 10.4%. Very, very good spot to be. So with that, Remy, I'm going to open it up to questions.
Perfect. Thank you, Cean. So Yeah, like we had mentioned at the beginning of the webinar, if anyone has any questions, please feel free to submit them in the questions box. And we will answer them in the order that we receive them in.
We'll give it about a minute, Remy.
Mhm.
If no one asks a question, then we'll just call it. Okay, it sounds like we don't have any questions. So with that, it's 5 o'clock. We're right on the hour. Thank you for joining us. And our next guide to the markets or wealth market insight will be the first Thursday in February. So until then, I'm sure I'll see everybody or talk to everybody. But thank you for joining, and have a great weekend. We'll talk to you soon.